Hello, everybody. Good afternoon. I'm very glad to have you here. My name is Otávio Pitaluga. I'm the organizer of these Tech Lives. We have today a very old friend of mine, Jerome Wittema. He was born in Belgium, and we met by 1998, so a long time ago. And we met during the MBA program of the Rotterdam School of Management in Rotterdam, Netherlands. Jerome was very lucky, or unlucky, you may say, because in the first course that we took together, he was assigned to be my partner. It was statistics, so he suffered a lot, but it was a very nice experience, and we became very close since then. Jerome is based in Luxembourg, and I'm based in Rio. And he has been trying to get rid of me, but I told him that no way, it's a long-term, lifetime friendship, and I'm very glad to have you here. It's a honor. In my opinion, Jerome is one of the best experts in startup valuations that I know. And for you guys, it's very difficult to find time in his agenda, so I hope you can enjoy his presentation. While we are waiting a little bit for people to come up, I will share a screen about Tech Lives to say about the next lives that you have in English. In English is every Thursday by 1 p.m. Rio time and 6 p.m. Europe time. But then in Portuguese, we have it every Tuesday, 7 p.m. Brazil time. So we have Jerome today, and then within 2 weeks, we are organizing these international lives every 2 weeks. I'll run the show about the Chief Networking Officer and Stakeholders Management. I have 4 cases, nice cases to share with you guys, applying this methodology to big companies and also to smaller companies, to startups, to PMEs, and individuals. It works very fine, and I hope you can enjoy it. Please subscribe. And in Portuguese, as I said, you have many more lives. I will also run the same show in Portuguese next week. And then there is another one about financial self-sabotage. This is supposed to become one of our very good lives because they have almost 700 subscribers. So I hope that is really boom. And then you have the whole calendar here. You can go through, and you see that we have people talking about leadership, about movies, energy, startups, sales, governance, innovations, future of innovations, and consumer, and also electric mobility, LGPD. So we have everything here. So that's enough. And then I will remove my presentation. And so guys, please say hello. If you want to introduce yourself, it's a good time for this. And Jerome, whenever you want, you are ready, I will share your screen, and then you can introduce yourself to the crowd and start, running. I have to stop this, and then, okay. Then you can start running the show.
Very good. Thank you, Peter, for this kind introduction. So a couple of words about myself. I've been a VC for 20 years, roughly, and I've been investing in tech for about 30 years. So my firm, Exponential Capital, we're investing mostly in Europe, but also US and Israel, in companies that scale, meaning that have the potential to become multi-billion-dollar companies. And we've actually already invested in a few of them that have become of that size and that successful. So I think Peter thought that this was credible enough to so that I could speak about valuation. So this is what we're going to do today. So I don't know if you can actually speak up, but don't hesitate to ask questions or maybe in the chat. And let's start. So we're going to talk about how much company is worth. I'm going to help you to understand where you can even start. That maybe it's not that complicated, and that you shouldn't be scared talking about valuation. So, and by the way, I'm talking about startup valuation in the context of VC investment, but actually it applies outside of VC investments as well. So relax, be cool, this is gonna be fun. So yeah, the first thing is, what is it that you cannot understand in this very easy, very simple and straightforward formula? I don't understand what is complex about that. I'm joking, of course. You're gonna see it's fairly straightforward. So a bit of background in terms of what exit valuations have been over the last decade. So what's interesting is you look at the 25th percentile and the median. And that's in millions of euros, this one in Europe. But in the US, it would be roughly similar to that. What it means is, over the last decade, and it was worse in the first decade of the century, when you would sell a company, typically you would not sell it for more than 40, 50 million euros, right? And it's only in recent years that we've been able to sell a few companies at around 100 million, and now only in the couple of years where we've been able to sell companies, not exceptions, but on a regular basis at 400, 500, 600 million euros. So that gives you some sense of, okay, what is going on in the market, right? Why it's relevant to think about valuation is because, so this is called the power law distribution. This is the distribution of exits by size since 1995 in enterprise and consumer. So it's enterprises in blue, consumers in green. On the on the left-hand side, you can see that around 50% of companies get sold for between $0 and $50 million, right? So that's the highest probability is your company is going to be sold for, if it doesn't crash, of course. When it gets sold for, anywhere between 0 and 50. And then the higher you go, above 50 or above 100, the air becomes scarcer, right? Meaning that there's very, very few, there becomes to be very, very few occurrences of sales at higher prices. And then on the right-hand side, you have the multi-billion dollar exits, of which we all hear about in the media. And that, of course, has increased quite a bit in recent years. So now, after this small context introduction, let's talk about value and what value is. I like this quote that says, ideas are worth nothing and execution is worth everything, because it really sums up a lot what the reality is. A lot of people are coming every day, coming up with ideas. All of you have probably had ideas, or your friends have had ideas, but who has actually made a company out of it? Very, very few people. So it's jumping ship from where you are to creating something takes courage or takes will, and then above and beyond, it's execution and quality of execution that will be worth something to you and to investors. So what we're talking about in terms of value is the sum of money, knowledge, execution, and influence. And it's also, value is the stuff the firm owns, right? If you have a sofa in your firm or a computer in the firm, that's what, the value of the firm can be construed as the sum of all the stuff that the company owns. But it's most importantly, it's the future the value of the future cash flows that the company is going to create, right? All of the profits that are going to be generated over the lifetime of the firm. And these cash flows are a function of your knowledge, the quality of the execution, and the influence of the firm and its market. So that's what I just said. Future value is a function of market size as well. Very important. The larger the market, the higher the value can be. The growth, of course. The competition, whether there is no competition or a lot of competition. A lot of competition means there's not going to be a lot of value creation. And there's going to be small margins, of course. And whether you're a leader, whether you have a lot of clients or very few, the more clients there are, typically the more value there can be. And then you have the typical drivers of valuation. But the last one is definitely the most important. It's the team capacity to execute, right? Drafting a plan is very hard. Executing on the plan is even harder, right? And that's what investors invest in, is a team's capacity to execute. Now, when talking about valuation again, there are a few methods, right, of assessing the value of a firm. I like this picture. It's pretty funny because it sort of describes what value assessment is, and definitely it is not a science. It is more of an art form, right? There are a few methods, so I'm going to be a little bit, let's say, professorish here. There's the net worth method, the VC method, there's comparable transactions, multiples, the DCF, discounted cash flow. And then you have the last one, which is very important in my eyes, which is the rule of thumb method, which I'm going to talk about. So the first one is the net worth, right? You take the value of the assets of the firm, you deduct the debt, and then you have a value. That's called the bottom value. We never use that, but it's a valuation method, right? It's out there. It's been used throughout history. It gives you the sort of the lowest possible value for your firm. Then you have the VC method, which is used by VCs, obviously, which is based on how much VCs need to return for each investment. So you invest 1 million. How much do you need to return? How much money do you need to get back when you sell the firm for the stake that you have acquired, right? And so I'll guide you through the 6 steps now by taking the example of a fake company I called UBooker, and UBooker is raising 3 million euros, right? I hope you follow me. So that's the start. Step 1. We need to determine the future results of UBooker in 5 years from now or later. So in order to do that, we need to make an assumption, right? For revenues or EBITDA maybe, and we take an example, it's gonna make 36 million in revenues in 2025. I'm sorry, I should have corrected this. In 2025. So that's the first thing. So you typically, as founders, you will have projections, and as VCs, we're not going to believe your projections, of course, because we know they're always wrong. They're always wrong, always. There's not a single time in my lifetime or in any VC's lifetime that they have been right. Sometimes, very rarely, they are above the target, but that's just more like the 1/1,000,000%. But it happens. But mostly they tend to be lower, and the reason is, as entrepreneurs, we are over-optimistic, we're overconfident, and there's ample academic research and evidence that proves this point. So it's not even arguable. So the first thing is we determine the future results. In 5 years, to 2025, what is UBooker revenues going to be? The second step is we need to determine the terminal value in year 5. So in order to do that, we need to identify the comparable multiples. And that means that if it's a multiple of revenues, right, we need to look at, okay, what are comparable companies, right, in the same sector that maybe are listed on stock market, and that could be used as a proxy of what the company is going to trade at, what it's going to be valued when it reaches that sort of size, right? And here we have identified a multiple that's 4 times revenues, right? 4 times revenues, and so we multiply the 4x by the expected revenues in 2025, and we come up with 144 million, right? Fairly straightforward, I hope. Nothing too complicated there. The third step is we need to determine the expected dilution, right? So what is the dilution? The dilution is the investor is going to own, let's say, 20% in the firm when she invests in the company the 3 million in UBooker. But the problem is they're not going to own 20% forever. And the reason is there are stock options that are going to dilute the ownership of the VC down from 20% maybe to 18%, right? And then there's going to be other rounds of financing. There's going to be a Series A and then a Series B and maybe a Series C. And so there's, in the end, the VC is probably going to own something like 10%, right? So I made an assumption below here. Employees are going to get 10% of the firm over 5 years, and the company is going to get one additional financing where investors get 25% equity. So the dilution here is expected to be 35% for my investment, okay, in UBooker. Now, the step 4, we need to determine what is the required rate of return. And on the left-hand side, you have a table, and you can see that at each stage of development, seed stage, startup stage, first stage is probably Series A or Series B, and so on and so forth. So the more mature the firm is, the lower the required rate of return. What is the required rate of return? Is what investors require of a firm's value to increase on an annual basis, right? So for seed stage, if it's 70%, it means that after we invest now, in 1 year, the company needs to be valued at 70% more. So if I acquired shares of a company for 100, 1 year later, they're worth 170. Very straightforward, okay? So here you have the ranges of the rate of return, okay? So here I've just put a table just for reference of what the IRR is, which is rate of return, and you can see across the table the multiple on the x-axis across time, right? So if you want to do 10x over a period of 5 years, you're going to end up with an IRR of 58%, okay? So there you would not even reach your required rate of return for the seed stage, which I showed before, okay? Now, step 5, we need to determine the share of the value pie. Okay, what is it? Okay, don't be afraid. It's easy. So the return goal of, let's say here, it's 60% per year. So that's the required rate of return that I determine, right? So I decide as an investor, I want a rate of return of X. And in my case, it's 60%. So I decide based on the maturity of the firm, right? So if I go back here, 60% means I'm either in startup stage or in first stage, whatever that would mean. And I say, okay, I want my money to return 60% of my investment every year, okay? So after 2 years, it's not 160, it's 160 plus 60% of 160, right? So that's gonna be 230 or whatever. So a 3 million investment in UBooker after 5 years should become 31 million euros. Okay, and the way it works is, well, it's just 60% compounded on the 3 million for a period of 5 years. That's what it does, right? So if the terminal value of 144 million is what it is, then the investor needs to get 33.6% of the company today. Why? Well, 31 million divided by 144, that's 33.6. You get it? So we sort of do a retro calculation of what do we need, what percentage of the company do we need? That's the share of the value pie. And here we determine that in order to get the 60% rate of return per year, we need to get to 31 million euros exit at the end for our stake. And in order to get that money, we need 33.6% of the firm today, okay? Taking into account the 35% dilution, all right? So this last point is very easy. So if we get 33.6% of UBooker in exchange for 3 million, it means we are implicitly valuing the company at 8.93 post-money. Very easy. Why? Well, 33.6% for 3 million, and you do, it's a simple rule of 3, right? So you divide the 3 million by 33.6, and then you multiply by 100, and you get 8.93 million post-money. Very, very straightforward. I hope you understand that. It's roughly here, you get 1/3 of UBooker. If you put 3 million, then 100% is 3 times 1/3. Easy, it should be 9 million, right? So this is what we get. So question, I don't know if anybody can speak, but what is the pre-money valuation of UBooker? So I'm going to show you the post-money again here is 9 million, right? What is the pre-money value of UBooker? Anybody can say that? Somebody in the chat, maybe. Yes, no? Not a very lively crowd today. Oh. So, okay, I'm going to help you out. It's very straightforward. The investment is 3 million instead of 1 here on this slide. And in the end, you end up with 33%. So what it means that you take the post-money valuation, you deduct the investment, and you get the pre-money. So in this case, the pre-money is 6 million. Very easy. 9 million minus 3, it's 6, right? Any question at this stage? No, so fully quiet. So this is it. Feel free to do a screenshot here of the VC method. It's all summed up in this very nice table here that you can see, and it applies all of the steps that I showed you just a moment ago. So I'm not going to go through that again because we just went through this. All right. So you had time to do your screenshots. So this was the VC method. Now let's go to the next method, which is what I call the market practice or the rule of thumb. It's whatever the amount being raised. So if you raise 1 million, if you raise 2 million, if you raise 3 million, if you raise 10 million, it doesn't matter, right? Investors will want 10 to 35% of the company at each funding round, right? And now you will tell me, okay, it's pretty wide, 10 to 35. Well, the reason is it depends on a number of factors, such as the maturity of the firm. So typically, angel investors will want to get up to 30% of the firm. VCs will only invest in exchange for minimum 20% at seed stage and minimum 10% at Series C. So you can see that the more mature the company is, the less dilution there's going to be, right? So in the beginning, you're going to lose maybe 30% in the seed, and the Series A maybe 20-25% max, and then in the Series C maybe 15. So these, of course, are not fixed. This is always subject to supply and demand, right? That's what truly drives the valuation. So if you have 100 VCs that say, we want to invest, and of course, you're going to get a crazy high valuation. If nobody wants to invest and you have to beg for money from investors, of course, the valuation will end up being pretty low, right? So another point, which is typically not necessarily well known by founders, is that founder ownership matters. So you need to be careful giving away too much ownership too early, right? VCs will not invest unless founders own at the very least 50% of the Series A. So if you own like 30% at Series A, a professional VC will not invest, because they will think, we think, you own too less of the firm and you will not be properly compensated, and you will not have the proper motivation. So it's a huge risk, right? So there was a question about the VC method. Can you take an example with various dilutions? Well, the dilution in the VC method, it's very simple to apply, right? It's the more dilution there is. So the number here was 35%. The more dilution you have, the more share of the value pie the investor needs in order to get to the required rate of return, right? So it's very simple. It's very easy to, I think, to understand. So the less the dilution, the lower the percentage ownership the investor needs, because in order to get the rate of return, there will be less pressure on the ownership, right? So I hope this is helpful. So that's it for the valuation methods. I think I've been pretty fast on this rule of thumb market practice one, but this is the truth. This is how the whole world works in terms of value. It's roughly an investor will want a certain percentage, and that is going to typically be 20% at the seed or Series A stage, maybe 30% at the seed stage, and it's going to be lower and lower as time goes by. Right. So we're gonna. I need to make a mini 1 minute break, if you don't mind, and I'll be back. So just in a few seconds, don't move. Les enfants, après que vous descendez 10 minutes, ok? Alors vous voudrez que là, voir le chien. Allez, votre côté. Allez, fille. Oui. There we go. Sorry about that. Okay, I see there was a question also about a hurdle rate, right? The is it really used or it's only theoretical? No, it's not theoretical. It is there is an expectation of return at each and every stage of investment, whether you're talking about seed, whether you're talking about Series A, Series B, Series C. So the more the company progresses, the less return is required because there are less risk there is, right? Quite honestly. So it's pretty straightforward, I think. And the table I showed you is really an example of what let's say the ranges are typically in the market, right? All right, so let's go to the next slide. So here I just want to give you a little bit of more context, more flavor about what is going on. So you can see in Europe over the last 5 years, there's been really a very sharp fall in the number of small seed rounds. It's really crashed by more than half, while the others have been growing. So the round sizes have increased significantly. The small rounds are disappearing. We're really saying, those $0 to $2 million round disappearing completely, and the bigger rounds are becoming much more the norm. You can see that the deal size have increased over the last decade tremendously. From at seed stage, for instance, from average 500,000 euro tickets to now 2.5. So 5x increase in deal size. In early stage, it's the same sort of story. It's more than doubled, and in late stage, it's more like quintupled. So late stage deals in Europe didn't really have enough money a few years ago, and now they definitely have access to a lot of money. And the valuation, of course, have been in sync with the ticket sizes, which makes total sense. At least if you're in the business, you understand they're both synchronized. And I just explained to you just a few minutes ago that they are synchronized because at each and every stage, the investors will want to have, between 10 and 30% of the company. So no matter how much they invest, that's what I told you. So that's how it works. So in terms of capital requirements, here, maybe you want to screenshot these ones as well. There's at each and every round, right? There are questions to answer by the founder, right? And these are very important, questions. And the money should be used, the money or the capital K should be used to answer these questions. If with that money, so in seed stage, 1 million to 2.5 million, if with that money, you did not answer those key questions about technology, market, and timing, you're in for trouble, right? You're not going to raise any money, or you're going to be lucky raising some, but you shouldn't get any money. If you have not been able with that kind of money to answer those questions, then you're not a good founder. So you can see that the capital required is going to increase the more you move down the table, and the pre-money valuation on the right-hand side is going to increase as well. You can see here from 4 million all the way to 150 million. So that's the curve. And then the questions, of course, change across stage, and the first questions are very simple. Does the technology work? Is there a market? And then the final question in the series B or C is, can we grow faster than this? Can we scale and automate on a very big scale from 1,000 customers to 100,000 customers? So pretty big questions. And of course, the risks and expectations are changing as well. Here, it's you can screenshot this one as well. The investment risks. There are a number of risks at each and every stage, and I think that founders need to really understand that these risks influence the valuation, of course, and in turn, they influence the expected return on the right-hand side. So why is setting the right value relevant for you as a business owner? Well, when valuation is too low, then you're not going to be able to raise enough money, and which means that you're not going to have enough time to build value, right? To answer those questions. In order to answer the questions that I mentioned in the table before, you need time, right? And you typically need at least 12 months, but that's too short in most cases. And typically you're going to need 18 months, right? Now, these days, even 18 months is even, I mean, in the times of crisis, in times of COVID, for instance, I hope any founder will appreciate you would have needed more like 24 months to be on the safe side. It panned out pretty well for a lot of people during the crisis, but I can tell you not every founder was happy and was in the right sector at the time. Well, the valuation could also be too high, but then what you're putting on your shoulders is that performance expectations are going to be very high. The probability that you can deliver those very high expectations is going to be low. And reducing valuation is going to be pretty difficult to do. And it creates a negative spiral, and you don't want to be there. You want to create a positive spiral. You want to increase the value by starting not necessarily too high, and you decrease, of course, when you have too high a valuation, the probability to find follow-on financing. I can tell you this is a recurring issue we've seen again and again and again, and it kills businesses. It just kills them. What does all this mean? Well, at the seed stage, investors expect, I told you, between 70 and 100% IRR, so let's say 80%. And in money terms, it means that if you set the valuation and raise 1 million at 4 million pre, investors will expect that your startup will be worth 9 million pre-money a year later, right? So it started at 4 pre, right? You say, my company is worth 4, that's what you say. You get 1 money, so it's worth 5 million post money. And 1 year later, if the investor expects 80% IRR, the investor expects at least a valuation of 9 million pre-money on which you're going to raise money. And 2 years later, that same investors expect the company to be worth 16.2 million euro pre-money, on which you could raise, for instance, 4 million on a 20 million pre, and then give 20% of the firm. So as you can see, these are very huge value increases and very difficult to sustain. At each and every increase, it needs to be sustained by real, tangible KPIs, right? And it's not out of the blue. Typically, with those kinds of numbers, you need MRR, you need a certain level of ARR. MRR, so stands for monthly recurring revenues, ARR for annual recurring revenues. In SaaS, it's the typical type of metrics we're going to look at. And of course, we're never going to pay 16.2 million pre for a company that does no MRR or just 10,000 MRR. You're just dreaming. It's never going to happen. So the 1 million needs to be raised in order to last at least 18 months, in order to answer the questions and generate sufficient proof of traction and deliver the right metrics. So what do you do with the valuation? Well, for me, it's really the base for the transaction. It's you establish it to get resources, and the resources, the most important one is time, right? Time, that you're buying time. This is what you're doing. So you get the money from investors, that money gives you time. So this is the exchange. In exchange for time, you're giving a percentage ownership to investors. Of course, it's not only time, because it's capabilities. I mean, time with 1 million or time with 100 million is not the same thing. But in essence, it is what you get. Now, a few words of advice. The first one is you need to define as precisely as you can how much you need to raise, and how much the revenues or number of users or whatever KPIs are relevant to your business, your company needs to get to in order to get to the next round. And from that, you're going to be able to infer the amount of money that you need, and the kinds of resources that you need to apply. Of course, you need a buffer in order to make sure that you get there. So you're not going to raise money for like 18 months, and in the end you spend too much, you didn't get the revenues you wanted, and after 12 months you're out of cash. So you're overconfident as a founder. That's who we are. But you need to add a buffer, and make sure it takes the firm to at least 18 months. Otherwise, it's not even worth moving forward. Bottom line, well, 94% of founded companies will fail to raise a Series A, and it will be stuck in that zone. If that happens to you, the only piece of advice I can say is move on. Move on. Persistence can have some merits, but in most cases it doesn't. Business idea is not good, or well, that's the explanation. The reason why companies fail is the business idea was not good, or the money raised was not enough, or the valuation was too high, and then you can't raise, right? So that's what I explained earlier. So the key takeaways, and that will be it. Think about it, is try as founder to be realistic. The less you have in your firm, in your startup, the less it's worth. Of course, you always think, I have a lot, it's amazing, my idea is unique. But if it's an idea, it's not much, if at all. The earlier the company is, the riskier it is. So seed stage is not the same risk as a Series D or E or F, where you have already 100 million in revenues, or something like that. Seed money, you need to understand, if there is an investor, they need to roughly double their money after a year and a half at max. So you need to generate the kinds of value so that they can get there. And valuation, there's a lot of talk as founders. I've been there as a founder earlier in my career, and we always think our company is unique and has there's nobody like us, and we have this it's just so amazing. Well, the reality is, it doesn't mean anything until there's in the end you sell the company, and somebody acquires the company and pays a certain amount of money for the company, not as an investor to take a share, but the company that buys your company, they're going to put a real price on it. All the rest is fairy tales, right? But we do need those fairy tales. Thank you so much. Let me know if there's any more questions.
So, Jerome, thank you so much. It was a wonderful class, very, very didactical, very easy to understand, even for someone like me who's not into financials. I think that the audience, I don't know the background of our audience, because people didn't introduce themselves so far, but I hope they can do it. Don't be shy, guys. Let's show up now. And I have one question for you that I'm now was researching here. I'll post here for you guys to take a look. Um, is the following. Let's see if you really be nice for everyone to take a look. I don't know, but I'll anyway. It's like this. Daimler AG bought 10% of Tesla for $50 million. 5 years later, they sold their shares for $1 billion. Today, 10% of Tesla worth $53 billion, while 100% of Daimler worth $77 billion. Which means sometimes you have a winning horse passing in front of you. Okay, you bet 50 million at that time. 5 years later, you got a multiple. 1 billion is enough. I made my good money. However, later, then and this by it was 5 years later. It was 2014. Okay, 7 years ago only. 7 years ago only, and today Tesla worth much more than this, and much more than Daimler altogether. My question for you is, what about this gut feeling of the investors to decide how much they put the money, what is the right to share, and also the exit strategy? Can you please tell us something about it, given your experience, Jerome?
Well, it's an interesting subject, and there's quite famous investors have talked about this, and like Bill Murray, for instance, and he's been saying, the single most prevalent mistake in investing doesn't come from making a bad investment or a good investment, or it's in a bad company or a good company. That's not the point. The point is the behavior of the investor, right? And here, the example you showed with Daimler is not an issue with Tesla. It's an issue with the behavior of the investor. The investor sold too early because they didn't understand what they had invested in. They had not invested. They did not understand. And I don't think you can blame investors for not understanding things. It's just the way it is, right? And some investors get it. Some investors don't. Well, those that don't get it, they are not going to make the profits, the big profits. And those who do, they are going to make the big profits. That's how life is, right? So the biggest recommendation is always to try and understand and behave, take a right behavior, and the right type of behavior to take in specifically in technology is just stay as an investor over the long run. And the long run doesn't mean 5 years or 10 years. It may mean sometimes 20 or 30 years, right? So I'm saying here 20 or 30 years. I don't know if you heard what I said. Because that's the story of Apple, Microsoft, Intel. You look at at the valuation of these firms, or Amazon. You could have said the same story about those firms as you did with Tesla. It's the same story. You wait for another 10 years, and instead of having a company that's worth 100 million, it's worth 1 trillion, right? Well, guess what? Wait another 20 years, and it's going to be worth 10 trillion, or 100 trillion. I don't know. So patience.
Do you think that Daimler, because Daimler was in the car manufacturing business, so they were supposed to understand, but then they thought that Tesla was just another car manufacturer. But then Tesla is not just a simple car producer, but they are innovation company. And the companies that you are mentioning, those who are super valued over time and time, is because they keep going into innovation path, in the innovation barrier, much faster than the others. And they are always discovering new niches or new markets, or they reinventing, they are creating much more valuable products. For this reason, they are much more valuable perceived by the market and appreciated into their shares, right? So
Yeah.
the innovation thing, the innovation is a key factor for companies to be highly appreciated. Is that correct?
Yeah, of course. Absolutely. I mean, you said it. I couldn't say it any better, right?
And then in your case, in your portfolio do you have today, do you prefer companies in different sectors, only based in Europe or based somewhere else? What about the companies that were launched or born in third markets, let's say in Latin America and markets like this? Or so what is your, I saw the list of your criteria, but then how do you assess, how do you create your portfolio?
Yeah, well, that's a very big question. I don't know if I have time to explain that. So we invest in across Europe, the US and Israel, but we focus really on Europe. We're very much more opportunistic in outside of it. We don't invest in other areas of the world just simply because it would be just too complicated for us. We can't. We're just a small team, 7 people. And the Earth is just a little bit too big for us at this stage. So the way we look at investments is unique compared to other VCs, right? Each VC has their own unique set of criteria. There's no one VC is similar to another, right? And our criteria is, well, one, they need the firm needs to have a very big ambition. So we want companies that are going to reach at least 100 million euros or dollars in revenues in 5 years. So as you can imagine, there's very, very, very few companies that can actually do that. Even if some companies, they say they want to do that, but we look at the team and we know that they cannot do that. So we invest in teams that will not only have the ambition to do that, but we understand and we see that they can do it, right? So it's that super high ambition. And 2, it needs to be mixed with a big mission, and that is to solve one or more of the United Nations Sustainable Development Goals. So because we think that when you look at the United Nations Sustainable Development Goals, they offer a multi-trillion-dollar opportunity across the next decades to come to solve very meaningful issues for people on this planet. And we think we can make both a lot of money with those opportunities, and we can have a very positive impact by making the lives of people better. So that's, in a nutshell, that's what we look at. Of course, there's probably 50 pages of criteria we have in our let's say screening tools. So it's difficult to go through each of them. But yeah, roughly speaking, we look at those things. We look at the value proposition. We look at the competitive landscape. We hate competition. We like blue ocean. We like deep tech, high intrinsic value type companies. We like platform deals. What this means is it's businesses that do many things, many different things, that have many options. It's like, when you go to a restaurant, there's not only one dish, but there's many different types of dish. So you're going to make money because you offer, a fish burger, a vegan burger, and a meat burger. So in the end, anybody that comes, if they want to eat, they're going to find something. So we don't like to invest in companies that only do meat burgers. That we think it's too narrow, and we know it's a risk that someday maybe people will say, well, I don't like meat burgers, and nobody will want meat burgers one day. So yeah, that's how we look at it.
Yeah, but do you have a preference for sectors, or saying health, technology, or any things like this, or preference? Another question, just to go very quickly, is do you really need to act at some point, or you can stay much longer? You say, okay, this is a big winning horse, I will stay as much as I can. Or I dilute myself much slowly than,
No,
what I
so
would
the
do.
funds like ours, venture funds typically are operating on a 10-year horizon. That's the market standard, and so that means that by the end of the 10 years, we need to have exited all of the portfolio companies.
Uh-huh.
And I mean, in the industry, there's this average, 7 to 8 years, depending on where you are in the cycle. And if you're, hitting a rough spot, it may be, 9, 10 years. And if you're in a very, very high velocity market, like the one we've had in recent years, then there can be some compression of time, and then you can exit in 5 years. But that's pretty rare. So
Concerning sectors, do you have any?
sectors. So we have we're sector agnostic, but we do have a list of no-nos. So there are things that we don't do. There's which is perfectly in relation with the ESG and UN SDG. So we don't do the typical things, the sin type of businesses, sex, drug, and rock and roll, as they say, or weapons and these kinds of things. But there's more, of course, than that. We have a long list of exclusions. I'm sorry.
And by the way, do you have any rule of thumb, like I invest between 5 million euros up to 20 million euros for a minimum of 20% equity, maximum of 35? Do you have anything like this?
So it depends. I mean, so some funds say, well, we want minimum 20% or 10%, or otherwise we don't invest. In one of our funds, we have a rule like that. It's minimum 10%. In the other fund, we don't have a rule like that. It depends on the circumstances from one fund to another. Some will say, well, we need to invest at least minimum 5 million. So sometimes it depends on the tax regulations in the country. So there's no, let's say, standard that I can share. You have to ask each investor.
And then, I mean, we are getting to 1 hour, and normally we try to limit the time here. So if nobody has any further question, that's my final question. Do you? I was just saying things, I forgot the question at the end of the moment. Anyway, I remember about pandemia. It's pandemia thing. 1 year and 1 year, 3 months ago, 1 year and a half ago. Do you think the market changed so much? Do you think you're having more opportunities? Do you think good companies devaluated, the price were reduced, and then it was good for investing, and then you are now getting a good return? So can you please say something about this last 18 months?
Yeah, roughly speaking, what's happened is that we've seen 10 years of evolution that's been squeezed and crammed up into 12 months, right? So there's been a tremendous acceleration of the adoption of digital technologies across the whole world, across every industry, across NGOs, education, healthcare, you name it, government. So this is going to have consequences for the next 10 years at the very least. So that we've it's like you're in a super sports car and you always drive at 20 kilometers per hour in the sports car in the first gear. In the last 50 years you've been driving at the same speed, and now it's like boom, you're going 200 kilometers per hour. So it's there's been a huge change in that has driven demand across all verticals, and there's just such a huge need to find the best platforms that are going to be helpful to any business that you're in. And I mean, it's of course this has had an impact on the revenues of those firms, which has skyrocketed. This has had an impact on the valuations, on the amounts of that have been invested in the industry. That's a big change.
So then you are optimistic. You think that those is a good time to choose some winning horses, bet them, and then in 10 years later you are a super millionaire.
Well, it's not
possible. Some stories like this can be told.
I don't think it's a good time or bad time. You never know when it is a good time or a bad time. You always know it with hindsight, right? Looking back 10 years ago, you knew that investing in 09 or 10 was the best thing you could ever do, because you would have 10 years of unimpeded growth, something we had never seen before. Such a long period of expansion, economic expansion in technology. Of course, you know it only after, right? And nobody knows before. Nobody knew that we would have such a big push. So you don't know what's going to happen in the future, and so the only thing to do when you're an investor is to keep investing. Year in, year out, invest, and not try to be smarter than anything else, and try to know things that you cannot know.
Okay, wonderful. Thank you so much, Jerome. It was a great pleasure. Really, really appreciate your presentation. It's a piece of master knowledge that we will share to everybody into LinkedIn, into all the platforms. I hope those who stayed with us appreciate it as much as I did. I have no words to say to thank you more. I just like to finally invite you guys to participate, to see our calendar. I'll be performing within 2 weeks about Chief Networking Officer. Please be there. And then if there is anybody who would like to suggest some other subject to us, or could have a good speaker to present into this stage, please contact us as well. So for everyone, thank you so much. Again, Jerome,
it was a pleasure.
Great pleasure. Thank you so much. Wonderful.
Thank you. Cheers.
Take care.
Bye-bye.
Bye-bye. So, Jerome, I think I said it all. It was really nice. I really appreciate. Really, really, really good. Thank you so much. And as I said, the audience, it was more or less what we expected, and about 10%. But that's it. This most important thing. That was a very good piece of knowledge that was shared, and it's just now coming to our library. Thank you. Big kiss. Take care. Bye-bye. Oi, então, tem 8 vídeos por lá, tem mais outros 2 prometidos. Eu não sei qual é a dificuldade que as pessoas têm de serem gentis. Você vê, o meu amigo gastou 1 minuto apenas para fazer algo super legal, né? Você imagina se todo mundo fizesse algo parecido, né? Seria muito bacana. Aí, de repente, pô, você vai e coloca só 2 linhas, né? Ah, legal, pô, adorei a música, pô, tô torcendo para que o fulano grave essa música e toque nas rádios. Quer dizer, não custa muito ser gentil, né? É isso, fica aí o recado. Beijo, te cuido. Porra, aqui tá uma maravilha. Cara, eu tô preocupado com isso aqui, eu tô tão preocupado com essa porra. Esse negócio. Não sei. Que saco isso. Aquela mulher deve ter guardado. Não sei. Eu jurava que estava frio aqui. Não sei. Muito obrigado. Adriana, quero dizer o seguinte, eu fui bem atendido, só que parece que a plataforma está com algumas limitações nesse momento, que a plataforma existente não consegue fazer o que eu estou pedindo, entendeu? Então, ou para fazer o que eu estou pedindo, a conversa é, você tem que ter um movimento feito do seu lado da API. Quando eu, sinceramente, me desculpa, mas eu discordo veementemente. Eu não tenho, eu, usuário, não tenho que ter API, não tenho que ter equipe de desenvolvedores, não tenho que ter nada disso. Vocês já têm isso e vocês têm, sim, condições de oferecer, porque o que eu estou pedindo é coisa absurdamente simples de ser feita, é capaz de ter sido feito assim em coisa de horas, de dias, pegando um melhor cara da equipe de vocês. Não é big deal, não. E, nossa, para o meu lado aqui, para os empreendedores e tal, vai facilitar muito, muito. O número de transações vai aumentar tremendamente. Pode ter, eu consigo garantir e justificar essa solicitação. Então, é esse o ponto. Eu agora estou saindo para me vacinar, e estou de volta aí ao escritório, à minha mesa, dentro de, sei lá, 1 hora, tá ok? Mas qualquer pessoa pode me procurar aqui pelo WhatsApp e vai ser um prazer tabelar e a gente conseguir conversar ainda hoje. Obrigado. Pô, eu adorei. Pô, I really love it.